general, companies grow. So if a company grows, we would hope and expect that the dividends are going to increase after year 3. So here's a formula that allows us to predict the dividends for n number of years, and then assume a certain growth percentage for all the growth rate for all the periods after that. So what we're going to do is, we'll assume, here's the formula, and let's say dividends will be $1.50 the first 2 years and $2.25 the next 2 years. After year 3, $2.25 year 3. After year 3, let's assume that the dividends start at $2.75 and they grow at 2% a year. Here's your formula. You'll plug in the growth rate right over here of 0.02. Basically, you add it to the expected discount rate. And that's going to give you a stock value of $43.92. Now, this is a very powerful tool to use because $43.92 is what you expect the stock to be worth. So if the stock is trading for $60 a share, this analysis will show you that this is a bad investment because you think it's only worth $44. On the other hand, if the stock is trading for $30 a share, and you estimate that based on the future dividends it's worth $44, then it's a very good investment because you're going to get a quick payoff. You're going to get more than you would expect, more of a return than you would otherwise expect. So the dividend discount model is probably the easiest model to use. There is an easier model. The simple PE ratios are very easy to use. They're not very reliable. Dividend discount model is a pretty serious model, and it's very powerful. The problem is that a lot of companies don't pay dividends. So for those companies, this model just doesn't work because there's no cash flow. The only cash flow would be from what the stock is worth whenever you're going to sell it. So you would have to predict what the future stock is worth 2 or 3 years from now, and all your dividends are zero. Use the present value term, just the present value of a single sum. Let's say 3 years from now, I think the stock is going to be worth $80. Present value over 3 years. That's not very reliable because we don't really know what the value of the stock is going to be in that period of time, and therefore this all falls apart. But if you have a company that pays fairly steady dividends, and there are a lot of companies that have reputations for this, that you can just plug this model in and it works. There are also some companies that pay high dividends compared to profits, and there are real questions about the sustainability. So you have companies where the dividends are irregular, so it's difficult to predict what the dividends are going to be worth. So there are some problems with this model, and research has shown that the return on net operating asset model that we're going to use in the next chapter is also a very powerful model that's slowly becoming popularized.